from the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Thursday the 21st, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. In London, I'm Guy Johnson. Alix Steel is over in New York, as you can see. Welcome to Bloomberg Markets, everyone. Alix, equities feel a little cautious today. The earnings granularity is important in terms of what is happening with single stocks, but by and large, a little cautious. Rates, though, pushing higher and higher.
Exactly, particularly on that front end, and I'm calling it kind of a safety Thursday situation. Stocks trading a little bit heavy. It's utilities, it's healthcare. They're in the green within the S&P. That's classic safety trade there. You were just mentioning yields pushing higher here, up 2 basis points on the 2-year. 41 basis points there is where we sit. No surprise then you're seeing some money flow into the dollar, the yen, and the Swissy. Euro dollar down, well, was down a little bit more, but 116 is where we sit. I just wanted to point out BITO, that Bitcoin futures ETF, now down after the third day of trading. You had JP Morgan coming out and warning of an increased cost of carry when you're playing this futures role. We've been talking about it for days, coming out and saying, guys, it's going to definitely cost you. And there's more futures ETFs kind of coming down the pike just in the next couple days, really.
Absolutely. The data continues as well. We continue to monitor what is happening here in key markets. The housing market certainly front and center as we watch this rates lift off really starting to take hold. But existing home sales continue to power on. In fact, better than anticipated in terms of the numbers that we're seeing. We are at 6.29. The market was expecting 6.1. We're up from 5.8 last time round. On a month-on-month basis, Alix, that takes us to 7%. So that market, maybe post a little delta dip, is starting to kind of gain a little bit of traction again.
Yeah, let's get to talk about what's actually getting traction. That's some of the top stories of today. We got Bloomberg Tonight Basics looking at WeWork's first day of trading. Abigail Doolittle is wrapping earnings that are all out this morning, and Bloomberg Washington correspondent Emery Hordern has the latest on proposals Democrats are exploring to fund President Biden's social spending agenda. So let's go to WeWork. You got a failed IPO. The co-working company WeWork is finally public through a $9 billion SPAC deal. It opened at 11:28. It's trading at 11:05 now. Here with more Bloomberg Tonight Basic. Is this a success?
I mean, everyone wanted WeWork to make certain adjustments, and we know this is a much smaller company. It is a success in that it is trading very smoothly, and it is trading higher today. You have a market cap right under $1 billion, or $9 billion. But of course, that is a far cry from the $47 billion that we once saw it flying at. Remember, Adam Neumann walks away with more than $2 billion as well, despite him stepping down from the board. He does retain some relationship with the company. However, this smaller, slimmer WeWork that still has a lot of losses to contend with is something that you see people buying the story for, at least for today.
At least for today. Shanali will come back. We'll dig into the details a little bit more a little bit later on as we track the progress of the newly listed WeWork. Let's turn to the earnings story that we're tracking so carefully at the moment. We're really in the thick of it. Picks up a little, even more in Europe next week. But there's plenty to dig into right now. Abigail Doolittle, over to you.
Guy, lots to dig into indeed. And let's start out with the big one. Tesla shares in the pre-market and overnight had been lower on a somewhat cloudy outlook, but you can now see investors rewarding the company up 2.1%. And of course, sales very strong, beating consensus, plus a record profit. We'll be taking a look at that in a moment. AutoNation soaring up about 11.7%. They beat in a big way on profits in a huge way. This as the average selling price really soared for cars. IBM on that chip shortage. And then we had some losers, IBM and Freeport not doing as well. As for the profit for Tesla, take a look at this here for the third quarter, $1.62 billion, sharply higher on a sequential and a year-over-year basis. So despite the chip shortage, it's really not affecting Tesla at this point. But Alex, for those companies that do miss, and you saw IBM and Freeport-McMoRan very weak on the day, we are looking at the biggest punishment for companies that miss going back to 2017. The average move down in the day after, down 4.3%, much more so over the last couple of years. And again, since 2017, actually not even shown on this board. That's how big the declines are for companies that don't manage well and don't beat expectations.
That's such a good point when you're really getting beaten up for those beats. Abigail, thanks very much. Bloomberg's Abigail Doolittle joining us. And stay with us for earnings. We're going to talk to Gary Kelly, Southwest CEO, later on in this hour, and Mike Jackson, AutoNation CEO as well. Looking forward to both of those. Let's go to D.C. because chances of an agreement on how to fund President Biden's social spending plan, which seemed within reach last night, are once again receding. Negotiators are reworking tax hike and climate plans to help with the support of Senators Kristen Sinema and Joe Manchin. Here with the latest is Bloomberg Washington correspondent Anne-Marie Hordern on Capitol Hill. And in the meantime of all of this, Joe Manchin trying to defend that he's not going to be leaving the Democratic Party. It just feels like more turmoil every moment we're looking at D.C.
Yeah, and speaking of more turmoil, right now the New York Times obtained a scathing article from veterans on an advisory board of Kyrsten Sinema, the senator from Arizona, saying they want to leave that because they just don't have faith in her anymore. So there's a lot of politics going on. But to the reconciliation bill, Alex, as you said yesterday, there did seem to be that we had at least a baby step forward in terms of how they were going to skim down the proposals and be able to come to some sort of agreement. And then this morning, it just feels like there was a massive step back. They are now going back into looking at how are they going to have the revenue streams for this, because Senator Kyrsten Sinema, one of those holdouts in terms of corporate and other taxes. So looking at things like billionaires tax, potentially a tax on corporate buybacks. So it's just back down to square zero, ground zero. And then the second thing I would also say is that the president had these two meetings with progressives and moderates at the White House on Tuesday. Then here at Congress, Speaker Pelosi is saying that actually the community college, getting rid of that, and also the child tax credit just going for 1 year, not till 2025. She says actually no decisions have been made on that. So what decisions have they actually made? That is still a key question, even though they say that they're making progress. The president yesterday trying to sell it in Scranton, and he's going to do the same, trying to sell it to the American people this evening in a town hall, but he needs to sell it to his own party. That's really what this comes down to.
Absolutely. It's amazing to see the divisions that exist and sort of fomenting those kinds of conversations around Joe Manchin's future and whether or not he stays within the party. He had a fairly robust response to that.
Yes.
Anne-Marie, thank you very much indeed. AMH in DC. Let's talk a little bit about giving you an update on some of the stories we've actually just been hitting. I want to take you back to Tesla. The NTSB is out with a report. Remember that fatal crash of a Tesla car back in April? We've been seeing an ongoing investigation around that. The critical headline from it, Alex, investigators clearing Tesla's autopilot in that fatal Texas crash, though the investigation is ongoing.
Yep, you can see the stock there up over 2%. In the bond market, just want to touch on that again, guys. 5-year yield now at 120, highest since February of 2020. Pushing higher here. Jobless claims were inching lower. You're seeing a move in the 2-year as well. Break-even's also high. 5-year inflation expectations the highest since 2005. All of those signaling those higher yields. Well, coming up, we're going to get a reaction to that, plus an investor's take on this earnings season. You got Jennifer Foster, Chilton Investment Company co-CIO, joining us next. This is Bloomberg.
Yields higher and higher. The US 5-year touching 1.2% within the last few minutes. As Alex said just a few moments ago, that's the highest since February. Joining us now, Jennifer Foster, Chilton Investment Company co-CIO. Jennifer, perfect timing. We need to talk about earnings. We need to talk about what's happening with rates. How do you reposition for ever higher rates at the moment?
So we believe rates could creep higher. I think our house view is that they shouldn't run away. There is still $11 trillion in negative yield globally, and that should act as sort of a governor on rates kind of running away. But what we certainly are seeing is that the underlying forces of the economy, even though there's a lot of noise, are pretty strong, and that that could push rates higher. We know the Fed is going to taper starting soon, and that could also sort of gently push those rates higher. We don't see them running away. But to position for that, you do want to be in companies that don't have a lot of leverage. That's one way to sort of make sure your portfolio is somewhat safeguarded from rates, which shouldn't run away, but of course there can be spikes as we readjust to a more normal future.
Jennifer, is the path of least resistance for a steeper or flatter curve? I honestly can't work this one out.
It's really confusing right now. And October is known to be a month when there's a lot of confusion in the markets. And I think we're seeing that because on the one hand, we're definitely seeing labor inflation. And, we're definitely seeing signs of commodity inflation. The question is, will that commodity inflation roll over as those commodities and the supply of commodities sort of catch up with demand as we move past the peak of these Delta cases, and hopefully we get more certainty in the virus. If that happens, then the economy forces should rise to the front, and those still feel pretty good to us. So we do see sort of a slightly steeper curve ahead because the economy seems to be in good shape.
Absolutely. But as you say, the inflationary story, the input cost story is definitely going to be there for companies to have to deal with. Jennifer, do you think this Q3 earnings season is going to give us the clarity we need as to who is a price taker and who is a price maker? Who can pass on these input costs to consumers? I look at Unilever out overnight. It is basically raising prices by 4.1%. Are those the kinds of companies that I need to focus on?
We at Chilton have always believed that you want to be invested in companies that have the ability to take price. It is sort of an inflation hedge that you just can't ever beat. And so, yes, the earnings season will help understand which companies can take price, which ones don't. But also remember, in some industries, there are contract lengths that require price to go into effect over time. It's not an immediate thing. And so we have to sort of take that into consideration as well. But for some companies, they're going to take price. If we see some commodity inflation roll over, those price hikes tend to stick. And then that sets those companies up actually for pretty nice earnings in the future. So there's a lot of noise out there, but the earnings season is great because you always get to hear sort of from the horse's mouth. And we love that as fundamental analysts, hearing from management teams.
It really feels like all the horses are saying something very similar. Over the past month, energy is up over 11%, financials up by 7%, materials up at 7%, which all makes sense in the higher commodity, maybe higher rate kind of world. How much more juice do you think is left in that rally?
Yeah, I tend to be a little cautious on chasing the commodity move here, simply because I'm just looking at the charts of that Delta spike globally. And it's very interesting just to see really how large that in our country, it wasn't the largest wave of this virus, but globally it was very meaningful. And we're on the downside of that. So it just feels to me like supply chains are going to start to, and supply of commodities is going to start to kick in at some point here. We'll see. It's unclear, but certainly, good companies, high quality companies that have control over their destiny, that have pricing power, that don't have too much leverage, they exist in all of those industries. And those would be the companies that we would be seeking out at this moment.
All right, Jennifer, thanks a lot. We appreciate it. Jennifer Foster of Chilton Investment Company. Thank you. And coming up, we're going to stay with the earnings theme. Southwest cutting its flight schedule yet again and doesn't expect to be profitable this quarter. CEO Gary Kelly will join us next. This is Bloomberg. Southwest Airlines posted a third quarter loss that was narrower than analysts expected. It is also trimming its flight schedule for the second time since August. Let's get the details now. Gary Kelly, Southwest Chairman and CEO. Gary, it's still a tough time for a lot of airlines. Your stock is down by about 1.5% so far. I just want to get your understanding of trimming your flight schedule. Is this it? Is this the bottom of trimming?
Oh, I think so. And you're right. It's we're still working our way out of this pandemic. We're beyond the survival stage and into the stabilizing phase, and it's just a matter of getting our staffing aligned well with our flight activity and our customer activity. So it's been a really sharp, the good news is there's been a sharp improvement in demand and travel and revenues. The Delta variant surge in the summer definitely hurt that, and by $300 million in the third quarter, in fact, which, that in and of itself is sort of an illustration of how volatile the world and the environment still is for us. But our normal staffing models just aren't as effective right now. So we're just trying to make sure that we don't overcommit and we deliver a great product for our customers.
Gary, you said in the notes this morning you were too aggressive going into Q3. Are you being too conservative going into Q4?
I don't think so. Relative to 2019, as a reference point, our capacity was down third quarter just 1.6%. So we were pretty close to being back to 2019 supply of seats, if you will, and available seat miles. So it'll be about 8% less in the fourth quarter compared to 2019. So that's still a nice recovery from where we've been, just not quite as aggressive as where we were in the third quarter. And as soon as our staffing can catch up, we will look forward to growing again in 2022.
It's hard to have escaped sort of the lines and the rebooking problems over the last few weeks, Gary. And I wonder if you've noticed anything in terms of booking passengers. Are they going to other airlines? How do you keep on that market share when you're still dealing with the capacity problems?
Well, our capacity compares well, in terms of our share, so there's not an issue there. And, we need to serve our customers very well. And with the ATC problems that we were dealing with earlier in the month, that really set us back. So, for a couple of days. But our bookings look strong, especially for the holiday time period. So we'll work very hard to make sure that we maintain the trust of our customers, because we clearly let some people down over that couple of days. It wasn't, it was not self-inflicted. The trigger was the FAA ATC issue in Florida. But nonetheless, we had to scramble to get our flight crews and our airplanes back in position, and that took a couple of days.
Gary, where's the landing zone for profitability, and a higher oil price is going to push it further out?
I think that's the main thing that's changing here from third to fourth. Really two things. One is the Delta variant, obviously, is in decline. And then fuel prices, on the other hand, are on the rise. So you have a plus and a minus going into the fourth quarter. But for the Delta variant, we would have been handsomely profitable in the third quarter, which I think bodes well, especially compared to where we've been for the past 20 months. So demand is back. That's the good news. Now we just need to make sure that we can deliver well with operational quality, and that is our focus. So I think, I don't know that we'll be profitable in the fourth quarter. Certainly I'm not going to give up on that, but we'll get off hopefully to a good start in 2022, and hopefully 2022 will be a very good year.
Gary, a lot of analysts are now looking at 90 oil, 100 oil, etc. If we stay with these levels over the next few months, can you realistically be profitable in the first quarter?
It makes it tougher, there's no question. I think the headwind in the fourth quarter alone is $120 million in terms of the increase in fuel cost. We're hedged, and the fuel hedge is worth over $900 million, so that will help mitigate the increases somewhat. But I think we're going to have to continue to do a couple of things. One is we need to restore our capacity to have all of our assets in the air working. Then number two, we need to deliver a high quality product, which means we've got to have the right staffing. And then we'll just have, what fuel prices are going to be what they're going to be. So hopefully we can make all of that work sooner than later.
Yep. Gary, you talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people to get the aircraft into the air, to get the aircraft that you've already got parked, and I can't remember how it is, it's kind of circa 20 at the moment, up in the air? How big a challenge is it?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce. If you just take the U.S. as an example, the participation rate has dropped by several percentage points. Well, we're seeing the same thing both within Southwest Airlines and out, trying to recruit and hire people. We've hired about 2,500 people. Our attrition rates are somewhat elevated. We're seeing more people out on leaves. We're seeing more sick. Of course, there are COVID cases that are influencing all of those things. So it's just a different environment, which is why we need to adjust our capacity plans accordingly. But we are hiring. We're a very attractive employer. It's a great company. We've got a 50-year history of no furloughs, no pay cuts, no layoffs. And we've got a great future ahead. So I'm very confident we'll do it. We're just going to have to prove to ourselves the pace that we can hire before we get out there and publish schedules.
Gary, you're a government contractor. You carry the mail. The president says there is a mandate for the 24th. People need to get vaccinated. You're not quite so sure. How many of your staff are currently fully vaccinated? How many do you think are going to be fully vaccinated by the 24th? And if they're not all, what are you going to do?
Well, when you say we're not quite so sure, so I'm very much in favor of getting the world vaccinated, number one, so we can defeat this pandemic. At the same time, as the leader of our company, I don't feel like I should impose my will on others and force them to get vaccinated. So we're just going to start from that position. We're a government contractor, and you're right, there's an executive order that mandates that our employees be vaccinated. So we're going to do everything that we can, our best efforts to comply with that executive order. The date is November the 24th. We're making good progress in encouraging our employees to get vaccinated. If they can't get vaccinated, we're encouraging them to seek an accommodation for religious or medical reasons. Yep. And we'll just see where we get to on November the 24th. The White House is sort of evolving the requirements to comply with the executive order, and we're going to do the bare minimum to comply, if you will, because it's not our purpose to ensure that everyone be vaccinated. We're encouraging that. Obviously, we want to maintain this government contract, Gary, so we're going to do everything we can to comply.
What's the number now? How many of your staff?
Well, we've got over half of our employees have reported their status. Of those that have reported, the supermajority of those are vaccinated. I'm not willing to give you a prediction yet. I will see how things play out, and we're seeing good progress here and I hope we'll see great progress between now and the 24th.
Gary, we wish you all the best. Thank you very much indeed for taking some time to be with us today. We look forward to hearing the fourth quarter numbers. Gary Kelly, Southwest CEO. Up next, fast food. This is Bloomberg. So it's been a long, strange trip for WeWork in its quest to go public, but it's finally happened. The shared office space provider is finally trading on the NYSE. This after, of course, a 2-year saga. It opened at $11.28. That's the price, not the time. Here with more, Shonali Basak, Bloomberg Wall Street reporter. Is this, as Alex said at the top, is this a tick in the box for Mr. Newman? This is something that he's talked about for a long time. He's walking away with a lot of money. It's finally happening. Kind of just talk us through kind of where we are in this journey, Shonali.
Yeah, I mean, we're looking at a much smaller company, and you see that in the valuation alone, but it is a warm reception this time for WeWork, and really it's Sandeep Mathrani over here, the CEO, and Marcello Claure over at SoftBank, who are now to credit for the transformation and a smooth onboarding into public markets, much different than the drama we saw a few years ago. And at the end of the day, this is a company that is highly exposed to a complicated sector in real estate at a time where people are exploring what the future of work should look like, and a lot of tough changes still to make ahead.
So why now? I mean, it's a tough tape right now. We're in a confusing time in the market. We don't know about rates. We don't know about inflation. We don't know about the Delta variant. Why'd they do it now?
Well, it's funny, not just WeWork, but any company that's going public, if you don't do it now and you wait until next year, you face a lot more headwinds in front of you. And so you can argue as well that, yes, it's more volatile than maybe a little bit earlier this year, but we've seen companies go public earlier this year with a lot more volatility baked into the markets. There is still a demand for companies that have growth on their side and have an upward trajectory and places to make money from. But again, this is a much smaller company and therefore probably easier to invest in.
Okay, so let's just pick up on that point, Shonali. The opportunity for this to be a growth company, and maybe it is being priced as a tech company, but certainly being priced as a growth company. We don't know what the future of office space looks like. How do you look at WeWork at the moment and make future projections in an environment where who knows whether people are going to continue to work from home? Who knows whether or not they're going to be working out of WeWork offices or similar competitors? How do you value a business given that uncertainty?
Yeah, it's a great question, and you can look at it glass half empty or glass half full, where you don't know what the future of work looks like, so how do you make a bet on WeWork? Or WeWork is the more flexible option, and therefore it's a better option to invest in. You can look at it both ways. You know, something that's interesting I always thought about WeWork was their relationships with big corporate partners as well. You know, working with UBS and Bank of America on large office spaces. And then also remember, I mean, part of the story that they've been able to deliver to investors is really getting rid of a lot of assets that don't work for them, especially in the real estate space. And so that idea to be nimble is on WeWork's side. And again, it's not something that, you know, investors are right now picking up on. And it is really, truly, I mean, it's been such a long road, guys.
Oh, yeah. I remember talking about this like years ago with you, too. So do you have an idea of who's buying today? Well, who's selling?
Yeah, I know. I mean, the retail interest would be interesting to get at the end of the day once the shares have all traded hands, because remember, this is not just WeWork, which is a very, you know, loved name and recognizable names amongst day traders, but also it's a SPAC, right? And so that's another big thing that we've seen a lot of day traders pick up on. Again, the method they chose to go public, Alex, you ask why now? Because the money is available to do so, and they did not do a traditional IPO, which would have had a much more involved roadshow process. And so again, I mean, you know, we've talked about bad SPACs all year. Right now, this is showing you're up almost 8% on the day for WeWork. So as smooth of a transition as you could possibly get.
True. All right, Shonali, thanks a lot. Really appreciate it. Bloomberg Shonali Basak joining us there. So let's follow the money, because there's another company making its Wall Street debut, and it's a Chicago-based restaurant chain known for its hot dogs and Italian beef sandwiches. Portillo's is indicated to open right now at 28. The IPO priced at 20. Let's talk to the CEO now. Michael Osanlu, and President, CEO of Portillo's, joins us now. Michael, $28. Your thoughts?
I was just listening to what you were saying about a tough IPO market, and I think that kind of belies that a little bit. We're excited by that. We think we have an amazing growth story, and I think that it just suggests that there's a lot of appetite, pun intended, for outstanding restaurant stocks.
Okay, let's talk about the growth opportunity. You've got plenty of stalls. We're looking at some shots. What do you call it? The beef truck?
The
that's
beef
what we're
bus.
looking at pictures of. The beef bus,
the beef,
sorry.
yeah,
the
it's in Times Square right now.
You've got to get the alliteration to work. Okay,
Yes.
so you're dishing out free food in Times Square. You're mainly based in Illinois, obviously, in terms of your kind of home market. I see you've got some places in Vegas, you're down in Florida, you've got some places in LA. Where is the opportunity? What are you going to use this IPO opportunity to deliver in terms of expansion?
Yeah, so first, the great news for us is we think that full potential in just the U.S. is well over 600 restaurants. And this isn't my opinion, this is sort of a fact-based study. Our growth is going to come primarily from two vectors. We're going to keep growing across the Midwest, right? We're already in 7-8 states across the Midwest, and we'll keep growing across the Midwest, leveraging a very strong brand based in Chicago. And then we're going to grow along the Sun Belt. We see tremendous latent demand for our business in Arizona, in Florida, and in Texas. And those three states will be a very big part of our growth equation over the next decade.
Can you tell me about how your customers are coming to eat right now and how you expect that to evolve as you expand? Like, are they in the restaurants? Are they just the trucks? Are they doing takeout?
Yeah, that's a great question. And it's a little bit more nuanced than I think most people fully appreciate. So in 2019, about half our business was dine-in. And when you fast forward to today, it's still only about 30-31% dine-in. The rest of it is coming through our drive-thrus, takeout, delivery, third-party delivery. I think that the dine-in business in the U.S. has not come back quite as strong as people might have thought. I personally believe that there's some tailwind for us. I think that the folks who choose to use restaurant companies via the drive-thru, via third-party, via digital, that's a different kind of occasion and demand. And I think there's still pent-up demand to go back to restaurants when people feel safe again.
How easy is it to scale what you do? Each of your locations slightly different. Each of the menus slightly different. It isn't cookie cutter.
Well, here's what I would tell you. It's more cookie cutter than you might think. So the kitchens, the layouts, the sales motion to the guest is 100% cookie cutter. What is unique is the cosmetics and the decor of our restaurants. So we want that restaurants to fit into the local population. So perfect example is we built a new restaurant this year in Sterling Heights, Michigan, right? It's a traditional Portillo's kitchen line. It's set up the right way. It's got the exact same menu as our core Chicago restaurants. But it is an homage to the automotive industry. There's a Ford Model T hanging from the ceiling. There's a Chevy Corvette coming out of a wall. And it's not lost on us that there's 3 big automotive plants within 5 miles of that restaurant.
Yeah. That's smart. You just really made Guy's mouth water now at that point. So let's talk about your input costs too. I mean, the pictures are pretty cool about your different restaurants.
Yeah.
Inside though, you're probably dealing with rising wages for your workers. You're probably dealing with rising costs for pretty much all food items, shipping, etc. What's your biggest headache? How do you manage?
Well, let me talk. I mean, I think most people will tell you that labor costs are obviously very high. The labor market is constrained. We are a values-based organization, so and I believe in enlightened capitalism, so we've actually been taking great care of our team members. We pay well above minimum wage. During 2020, in the heart of COVID, we didn't lay off a single person. We invested in our people. And our people are unbelievably loyal back to us. They love working for Portillo's. They work exceptionally hard, and they give our guests a great experience. So I'm not saying that we're totally immune to the pressures on labor, but I feel like we're in a really good spot because we take great care of our team members, and they're a little more loyal to us, and they work really, really hard. When it comes to commodities, look, we're facing the same dynamics as everybody else. It's just a volatile commodity market. We try to be really smart about forward buying, about taking excess inventory at the right time. We have price targets that we go for the most important commodities for us. We use a whole shoulder muscle for our beef sandwiches, and we buy that when it's within a certain range. So we've budgeted for an appropriate level of inflation in 22, and thus far we're seeing slightly better than expected outcomes as we buy.
Okay, one of my producers has run through the numbers in terms of what your sales mix looks like. 23% Italian beef, 60% sides and fries, 14% hot dogs and sausages, it goes on. Are those prices, as you say, you're trying to manage them, but they are going up.
Yes.
Are you raising prices for the consumer as a result of that?
Yeah, our strategy is to be a price laggard. So we took a little bit of pricing early this year. We took a little bit of pricing in the fourth quarter. We believe that our value proposition is one of the reasons why we're such a successful company. The average person who comes to Portillo spends $9.60. So just think about that for a second. $9.60 for an abundant, high-quality meal in a great environment. And so we are slow to raise prices. We took 3% pricing for the fourth quarter. We're done for this year. If commodities continue to be volatile, we'll look at a little bit of pricing, but we believe keeping a sharp price point and driving traffic to our restaurants is one of the keys for success to us.
Michael, when I finally make it back to the United States and they let me in, I look forward to trying it all. Thank you very much indeed for your time today. Great pleasure. Michael Osanloo, Portillo's President and CEO. Thank you very much.
Now we have a lot to do when you get here, Guy.
We do. That's
You're just adding stuff to the list.
I'm hoping I'm going to get up to Chicago. I got a few people I got to go and see up there, and maybe while I'm up there, I get to try the food too. Okay, what do we got next for you? We're going to take you to Canada, even further north. The C4K Investors Conference is underway in Toronto. Hedge fund manager Arnie Diaz, arrogant, global Management founder and CEO. Sorry, Anne, I can't read today. Is going to be joining us. That's coming up next. This is Bloomberg.
This is Bloomberg Markets. I'm John Hyland, live in the principal room. Coming up, AutoNation's CEO Mike Jackson. That's at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
I'm Eric Schatzker, live in Toronto at the Capitalize for Kids Investors Conference. This is all about best ideas, and I'm bringing you more with Anne Diaz. She's the founder and CEO of Aragon Global Management, started the firm back in 2001, equity long-short hedge fund, stayed open for 10 years, converted to a family office, and has recently reopened to outside capital. Anne, it's great to see you.
Great to see you.
And you're on the hunt for companies that can double earnings in the space of 3 to 4 years. Tell me about some of those companies.
We're looking for companies that can double their earnings power in 3 to 4 years, mostly by riding a wave of innovation and dislocation. So today, with cloud and AI and digitization, that's reshuffling the decks in every industry. There are going to be winners, there are going to be losers. So we're trying to find the winners that are going to double their earnings power in this period of time. So maybe to throw out a couple. One of the companies that we think fits the bill is Bill.com.
Bill.com.
Bill.com is a company that was founded by René Lacerte after some time at Intuit. And this company reorganizes your entire back office if you're a small business. Everything from payments to any kind of back office processes, so you, the entrepreneur, can save time and spend your time selling and innovating rather than having to spend your time paying bills, checks, etc. The company is going to grow tremendously for two reasons. It's got about 150,000 customers today. It's going to double that number of customers. And for each of these customers, instead of having one or two products like check paying or ACH transfers, it's introducing new products. And those products are much more profitable. So the combination of these two things will make it, in our view, a tremendous growth story.
Digitizing accounting and digitizing the back office for small and medium-sized businesses. Okay, Bill.com, what's another?
I want to move to Europe.
Ooh.
So I want to talk to you about a company called Sixt. And you might not have heard about it. It's the #1 car rental company in Europe.
I know this company, SIXT.
That's right.
Okay.
Started by Erich Sixt in the 60s as a local car rental agency in Bavaria. Then they expanded to Germany, then all of Europe. And during COVID, they actually picked up another American car rental company. So there's tremendous recovery in the earnings power of this company because it was affected by COVID. And now it's got another engine of growth, the US. But behind the scenes, this company is digitizing and transforming into a new business. There's been a generational shift in the CEO. The founder has passed on the reins to his two sons. And the company is becoming essentially a mobility company, not just a car rental company, but actually a Uber for long distance all across Europe, as well as a long-term car rental company where you can walk up to a car and with a QR code, open the door and rent it for 1 day, 1 month, 1 year.
I was going to ask you if companies that can double their earnings power in 3 to 4 years exist outside tech, and you just answered the question. They do. I wouldn't call Sixt a tech company.
Yeah, I call it non-tech tech. So this is a company that trades like a regular old economy company, 7 times free cash flow, but it's going to double its earnings because of this digital transformation.
You operate in both public and private markets, correct?
Yes, I think it's a continuum nowadays. In an ecosystem of competitors, you have public and private companies, so we have to talk to both.
So in the public market, everyone in theory has access to the same information, right? It's may the best man, may the best woman win. In the private market, it seems to me it's quite a bit different. There's still more opacity. And there are some investors, I think of Tiger Global, for example, but I could also name D1 and others that are throwing around enormous sums of money in the private market. How do you swim with those sharks?
So you're right. In the public markets, it's like drinking from a fire hose. It's not how you have access to information, it's how you process it. It's actually a little bit the same thing in the private markets. So our approach is to use themes that travel, but whether public or private, if you have a dislocation in a sector, the winner could be a private company, or it could be a public company. Let me give you an example. We recently invested in a company called Miracle. It's a marketplace software infrastructure company. So if you think of Shopify and what they do for the small merchant, this whole operating system, and if you think of Amazon on the other side, it's just a gigantic global marketplace, they do it in the middle. So if you're a manufacturer or supplier, in a turnkey way, you could suddenly have a marketplace. That didn't come to us from the private markets. That came to us because we know this is going to be successful. And we've seen this movie before. And I think the fact that public market investors are also aggressively investing in private investments, it's because thematically they're the same.
You've been doing this for quite some time, and what you said stuck with me for a moment. We've seen this movie before. Is that part of what differentiates you, having seen a type of business model and then something similar reemerge?
Absolutely. It's a blueprint for success in a business model. So whether it's in Latin America or in France or in the US, there's a right way and a wrong way to develop a business model. And so if you're transporting a business model across to Europe and it's been successful in the US, you know it's going to work. For instance, we have invested in a company called Zooplus. It's actually going to be delisted. It's being taken over by a private equity player. Zooplus is the #1 pet food and pet supplies company in Europe, 40% market share. It's only trading at 1x sales. It's exactly Chewy. They're using the Chewy playbook and they're essentially translating it to Europe, not just selling food, selling services, selling vet stuff, etc. So I think themes travel, there's a blueprint of success, and we're trying to ride that.
You've worked with the best, and George Soros, Stan Druckenmiller, Andreas Halvorsen, Julian Robertson of Tiger fame staked you. What does it take to stand out as an equity long-short manager today?
I think that those are, everyone has their own recipe for making money. And what is important is that it's consistent and patient. You don't want to change the dial all the time. I think if you're finding companies that have great fundamentals and are going to essentially be successful, that's going to translate into a financial earnings power that's also of that nature. And I think that's the common denominator between people. To me, it's a mosaic of facts. And you have to put it together to forecast the future and do that before everyone else figures out what's going to happen.
I've heard you use a term, European digital tsunami. What exactly is that?
So I think it took a pandemic and a divorce, Brexit, to have Europe come into its own. And I think there's a moment, a digital moment happening right now. I've grown up in Europe, and I've worked and traveled all across Europe, and it's always been very fragmented. You've always had really just a spaghetti bowl of languages and countries and regulations. Impossible with this fragmentation to have European champions. That's changing. It's changing for a few reasons. First, with technology and the massification of digital and technology stacks that are turnkey, it's a little bit like the advent of the euro. You can be in business in any country in Europe if you have a strong technology stack. You don't need to wait 5 years and have a team in Stockholm and a team in Barcelona and then a team in Milan. And so it accelerates the way that you can do business all around Europe. And then there's also a lot of money, private capital, public capital, entrepreneurs starting funds for the succession, and even the governments are at it. So I think a combination of technology, dissemination, money, and I think also ethos, because people know that the UK is offshore and they haven't been to the US in a long time. Let's make it in Europe.
Perhaps Europe's moment has indeed come. And it's great to see you, and thank you for spending time with me.
Thank you, Eric.
That is Ann Diaz. She is the CEO and founder of Aragon Global Management. I'm Eric Schatzker. This is Bloomberg.
Time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm John Hyland. Pent-up demand for the first U.S. Bitcoin exchange-traded fund has driven assets held in the investment vehicle to more than $1.1 billion in just 2 days. The ProShares Bitcoin Strategy ETF ended Wednesday with $1.1 billion under management, according to a press release. Bloomberg intelligence data shows that's the quickest an ETF has reached the $1 billion mark. And oil dropped amid a broad-based retreat in industrial commodities. Futures in New York lost 1.2%, declining from their strongest closing price since 2014. The structure of the U.S. crude market was soaring as stockpiles continue to drain at the key hub of Cushing, Oklahoma. There has been talk of a global oil hitting $100 a barrel. And that's the Bloomberg Business Flash. Alex?
All right, thanks so much, John. And speaking of commodities, today is Commodity Edge Day, so don't miss that. We're going to talk about what's happening in the oil market. Also, I'm going to talk to Michael McGuire, Simbridge founder and CEO of the company's new digital asset exchange built on Bitcoin, also has exposure to precious metals. It's a Bitcoin and gold combo, if you will, Guy.
Sounds like quite the combination. OK, what are we going to do next? We're going to turn our attention to the European close. Freya Beamish, TS Lombard's head of macro research, joining us. Markets are underestimating the repercussions of China's slowdown. That's the message. This is Bloomberg.